Well, good afternoon or good morning, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us today as we go back to the basics and looking at trade setups utilizing the principles of money management and risk reward. Now, today's event is sponsored by the Chicago Mercantile Exchange Group, the CME Group, I should say here. And before we get to Tim's presentation, I'd like to introduce Pete Molmat, who is with the CME, is going to give us a brief overview of products that we'll be discussing today, and then we'll bring Tim on for today's presentation. So Pete, if you can unmute your phone, I'm going to pass you the ball, and let's get started. Pete, you may have your phone muted. I see you're unmuted in WebEx. Try unmuting your phone. I'm still not getting any audio.
Let's try this. Here we go, guys. So sorry about that. Hey, guys. Thanks, Cynthia. Thanks so much. Oh, yes, it is a technical malfunction. And you know what? Thanks to everyone around the globe for joining us today. CME Group is so pleased to be co-sponsoring this event with IB. And we extend to you a welcome for today's presentation. Back to basics, trading setups, utilizing principles of money management and risk reward with Tim Morge. CME Group and IB have been working together to bring you professional educational webinars on futures for many years, and we encourage you to look in IB's webinar archives for past events from 2012 and 2013, as well as register to attend further monthly events. Here is CME's brief disclaimer and disclosure. Please take a minute to look at that. Futures trading is leverage trading. It may not be suitable for everyone, and there are risks associated to it. As a trader and investor, you look for opportunity in the markets and a way to capture that opportunity. Futures are an extremely flexible tool for expressing your market opinion and capturing trading opportunity. The CME Group futures and futures options markets trade electronically almost 24 hours a day, providing traders an opportunity to trade market volatility any time of the day from anywhere in the world. CME Group represents a family of individual exchanges, including the CBOT, the CME, NYMEX, COMEX, and the Kansas City Board of Trade Exchanges, with contracts covering all major asset classes, including FX, stock indexes, agricultural commodities, energies, metals, and interest rates. The CME Group is regulated by the US CFTC, the Commodity Futures Trading Commission. As Tim shares his theory behind his favorite trade setups today, he will be using the Japanese yen-US dollar pair. CME offers futures on the Japanese yen in both a regular size contract with a notional value of 12,500,000 yen, which trades at $12.50 a tick, as well as an e-micro contract at 1/10 the size with a notional value of 1,250,000 yen, which trades at $1.25 tick. The symbol in IB's on the Trader Workstation is MJY for that micro contract. It's a great contract as you're getting familiar and starting to use currencies. It certainly lets you manage your risk and gives you a little less exposure as to a full-size contract. CME offers futures on over 61 different currency pairs, spanning 21 different countries. And our volumes have been tremendous. In terms of liquidity, it is there 24 hours a day. The Interactive Brokers CME Group Futures Resource Center can be found at www.interactivebrokers.com/CME. And I think, Cynthia, if you can, oh, you're way ahead of me. Cynthia's thrown it up in our chat box. It's a great link. Start your day with news, quotes, and charts of all actively traded CME products. And this is something I am very excited to be a part of and participate in. The CME is sponsoring, along with IB, the School of Futures. We are going to have 12 segments throughout the year talking about different parts of futures trading within the asset classes and also some of the larger concepts in terms of understanding the markets. And our first one is coming up January 23rd, and it's going to be an introduction to the markets. It's a great introduction to futures markets. You'll become familiar with the jargon of future, who trades them, leverage and risks in trading, how the markets are organized, and much, much more. Please take a minute, click on the link, and register for this upcoming 2 weeks from today, this very interesting webinar we're going to do on the foundations of futures. Tim Morris has been a professional trader, author, educator, and mentor for more than 35 years. Besides trading his own capital, Tim is president of Blackthorn Capital, a private money management firm that works with several of the largest non-U.S. institutional portfolios. In the 80s and 90s, he managed and taught traders for institutions like Commodities Corp, J.P. Morgan, and Goldman Sachs. He remains one of the world's largest currency traders, routinely carrying positions of several billion U.S. dollars. Tim has taught hundreds of professional floor traders at the Board of Trade and at the Merck to become successful off-floor electronic traders. He is a regular lecturer at some of the most prestigious graduate schools of business and finance in the United States, including MIT, Stanford, and the University of Chicago. He currently generously donates his time teaching basic technical analysis to 4th and 5th grade accelerated students at 59 elementary schools around the United States. He is a regular featured speaker at the popular Traders Expos held around the world, writes a weekly column for MSN and MoneyShow.com, and gives educational webcasts for most of the exchanges around the world. He is the author of several highly regarded books, Trading with Median Lines and Mapping the Markets, featuring his own trading methods. His websites, www.medianline.com and www.marketgeometry.com, feature a great deal of free information regarding his trading methodology and are visited by thousands of traders from around the world on a regular basis. As always, thanks for making time in your schedule, and over to you, Tim.
Thanks, Pete. Hi, Cynthia. Happy New Year to both of you. And somebody give my regards to Barbara. I haven't seen Barbara in a few clicks. First of all, this is me. I want to take time to say Happy New Year to all of you. I know a lot of you are regular attendees. Thank you very much. Let's just click through the stuff real quick. That's our logo. Thank you. Futures and risk. You've had lots of disclaimers already. You can go back and look at it. I want to say to all of you, this seminar is dedicated to the people that come to these lectures, that's you guys, trying to improve your skills. I'm honored that you take time out of your busy schedule to come hear my thoughts. And obviously some of you are coming in 2014, so I appreciate you and your continued support. This is a presentation in the style that I use when I lecture at MIT and Stanford, so please be patient while the materials unfold. At the universities, this might be a 3 or a 4-hour lecture. Cynthia has now turned off chat, so I don't have to worry about this part, but please do yourself a favor. Keep your comments related to this material and this seminar only. And most of you here are here to learn my methods. Just respect everybody and let the seminar unfold and everybody have a better learning experience. Please hold your questions until the presentation is over. I'll answer all the questions anybody has at the end. I'm known to stay until the point where Cynthia yells uncle and just says, geez, can we please just have lunch? So don't worry about it. Just relax and enjoy the seminar. So today, yeah, it's good to be back. Some of you know that I had a tough 3 weeks. I caught a virus. Here in Arizona, there's a lot of viruses going on right now. And even my doctor was sick for 3 weeks, but I'm doing fine. So today we're going to talk about, it's the beginning of the year, and I have had a record year. This is my second record year in a row. And so how do you get off the mat and start off fresh? And, when I was trying to decide what to do for this month, I thought, I'd go back to the basics and talk about the 2 things that I rely on the most when I trade. And if you can pick up the basics of these 2 things, it'll make a world of difference in your trading. There is no holy grail. I'm not saying these are holy grail, but these are the things that I rely on. And I've been doing this a long time. I'm making a lot of money, manage money for really the 4 largest sovereign wealth funds in the world. And I use this in probably 90% of all my trades. So let's take a look. We're going to start out with theory. Don't get worried. There's not a lot of heavy math in it or anything. We're going to do the theory first, and then we'll move on into the practical. So, like everybody, let me get my little pointer here so Cynthia don't get mad at me. There we go. Like everyone, I begin the new year with no profits, no losses. Safe's empty. I have my opening account balance for the year. The slate's clean, ready for a new year of trading. The new year is always a good time to go back to basics, which is what we're going to do today. So let's assume that your account balance is $25,000. Not too large, not too small. It doesn't matter what it is. Let's just, for study's sake, just assume we're talking about a $25,000 account. Now, I was taught early on not to think in terms of dollars and cents. This is really important. If you can just pick up this, it'll help you. Instead of thinking in terms of money made or money lost, I was taught early on to think of all my accounts, all my dollars, everything in terms of units. There is no such thing as dollars. Just get it out of your head. See, then when you're paying your bills or when you got a house payment coming up or you're going to buy a new house, you're going to buy a car, it has nothing to do with trading, because trading is about units. If you can take the emotion of money out of the equation, it's much easier to think and act rationally when you trade. So over the years, I've measured my account balances, my risk and my profits and losses as risk units. That's what they called it at JP Morgan, Goldman Sachs. Numbers of stops rolled forward. That's what I used to teach in market geometry. And then I had a breakthrough with a student, Dr. Gary Fujinami, who's kind of under the weather this week. Hopefully he's feeling better. And we were doing a mentoring session, and I was showing him visually with a bar like this that was vertical. And he said, so it's kind of the, if it works, it's a go bar. If it doesn't work, it's a no-go bar. So we put it together. We started to call it the go, no-go bar. And you'll see as we use it, it visually will help you. So I make mine look like this in various colors, and I place them vertically on a chart to visually represent, because we're all visual, what I can afford above or below my entry for an initial stop loss. Now, since I always want to hide my stops above or below major market structure, once I drag over my standard go, no-go, I can just visually tell right away if I can afford to place a stop where I want that's hidden behind structure, above or below. So it's a visual way. You don't even have to do the math. You just drag the little bar over. So this is a visual representation of the maximum risk I'm going to take per trade. I use a technique called equivalent risk so that the maximum risk I take on any one trade is always equal. So for example, maybe my maximum risk is on a $25,000 account. On any trade, it might be $250. And this bar would equal in pips $250, or in ticks, $250. So if your account begins with $25,000 and you risk 1% each time you trade, inside of this safe, you got 1,000 of these sitting there that you can use. Think of it this way. If you use 1,001, you're gone. So we cut it into a large amount because we don't ever want to get anywhere close to the kind of drawdown that's going to endanger our account. Because once our account is in danger, we're done trading. And we all love trading too much for that. So each time you trade, you risk a maximum of one of these. And we're going to label these go, no goes, and they visually represent your maximum stop loss size. When you trade and make a profit, you're going to make more of these. So if you made 3 times your stops, you got 1, 2, 3 that you're going to be able to put in here. Now instead of having 1,000, you have 1,003. Note that I'm no longer thinking or talking in terms of dollars. Instead, I'm thinking and talking in terms of one stop as represented by my go, no go. So if I made 3 times my stop, even the profits are not money, they're turned into go, no goes. Now when I lose one, I take a loss, I don't think about money, there's no pressure about it. I'm just losing one of my go, no goes. Okay, it's a vaporous thing. Doesn't impact my mortgage, doesn't impact my ability to buy groceries this week. I don't think about it that way. Instead, I think about, you know what? I had 3 rolled forward. Now I got 2. That's fine. I'm still ahead. It's all good. Again, I'm no longer thinking or talking in terms of dollars. Instead, I'm thinking and talking in terms of one stop as represented by go, no go. So first thing at Commodities Corporation, they drilled into you. You can't think in terms of dollars. You have to think in terms of units. Boy, especially when you're managing money, because the amount of money that you're managing every day goes up and down by who's depositing money and taking out money. So you actually get spit out of it. You tell them what your unit size is, and then every day they give you a sheet that says, okay, today your unit size is X, 152. Tomorrow it might be 183. And pretty soon you don't even think, there's no such thing as dollars. And it's a good thing. So now we're going to look at something, and this is actually now a division of science, mostly economics. Risk opportunity analysis. Now don't get nervous. We're not going to do any math. We're just going to page through some things and make sure we understand some basic principles. A lot of people would say they come from gaming or gambling. That's fine. That analysis, a lot of people call it. But it's really called risk opportunity analysis because it even has to do with how we make decisions about how we buy groceries or toilet paper. Do I buy one roll or do I buy 3, get 2 free? What's the right opportunity? And you'd be shocked how many people that are well educated make the wrong choices. So you need to learn how to do risk opportunity analysis correctly. So now that I've introduced a new way to take the dollars and cents out of your trading, and that should reduce the fear or pressure associated with each trade, we need to talk about risk in its purest form. All of you want to take risk out of trading. I get that. See, that's not possible. We trade risk. That's what we do for a living. When we trade, we're risking. I mean, that's what it's all about. No risk, no money, period. So most of the people viewing this seminar are successful less than 50% of the time they take a trade. Actually, most of the people that are viewing this are probably at 40% or lower. Studies conducted by the NFA and the CFTC each year, year after year, show this to be true. In fact, I participate in a study with the NFA and the CFTC. Richard Dennis, Linda Raschke, and 2 other people generously donate our time. We've been doing it since 1993. We each get 10,000 accounts that have been blown up. They take the people's name off and all the private information. Then they give us these accounts with all these trades in there, and they say, you know what, take a look at each one of these trades, run them through your database, tell us what's going on. Why is this blowing up? And what we find is the number one cause is people A, overtrade, or B, over leverage. It's just the nature of the beast. So you want to keep that in the back of your mind. I'm going to show you why your perception may not be a reality, which is why you don't want to overtrade and don't want to be even close to being over-leveraged. So, do you have any idea what this diagram represents and how it relates to risk-reward? I know I said no higher math. Don't worry, I'm not going to make you solve the equation. I'll give you a minute to take a look at it. Does this give you a better idea what the prior diagram described? Does this image give you a better idea what the prior 2 diagrams described? Are you starting to understand what we're talking about now? So here's the mathematical description of a test of 1,000 flips of a coin. If you want to read it, go ahead and read it. It's pretty meaningless. It'll be in the notes if you want to go ahead and try it. You can put it in BASIC or one of the other computer languages and run it if you really want to. Every time you run this model, you'll get a cumulative representation of the sum of flips, +1 for heads, -1 for tails. Every run will be different, as evident in the next 2 images. You're going to see we're going to run it twice. Even though the cumulative value for a sufficiently large number of flips should approach 0. So if you do this an infinite number of times, of course, we should always have an equal number of heads and tails, because the odds are for each, here's the important thing, for each time is that it's 50-50. But that doesn't mean that if I do 10, I'm going to get 5 heads, 5 tails. And that's going to be important. I'll show you why in a second. So this graph represents the results of tossing a coin 1,000 times. I just ran that mathematical test here, and I got this graph out of it. The chance of throwing a heads or tails is equal, of course, 50%. But this test of 1,000 tosses produced a very negative result, which means we got a lot of tails. How's that possible? As my son, who's now 15, said when he was 8 years old, "Hey, Dad, the coin doesn't remember. It doesn't have any memory. Every time you throw it, it doesn't remember what it did last time." I thought that was pretty insightful. Okay, here's another one. This graph represents the same result of tossing a coin 1,000 times. We ran the code again. The chance of throwing a heads or tails is equal, 50%. This time, 1,000 tosses produced a slightly positive result. So this time we got about 15 or 20 more heads than tails. So completely different result. How's that possible? You would think 1,000 throws would be enough that it would be equal. Well, something funny happens. Even though the likelihood of throwing a heads or tails was equal, 2 tests of 1,000 tosses gave very different results. The number of tosses per test was statistically significant. If you tossed a coin an infinite number of times, the number of times heads came up and tails came up would approach an equal result. So what can account for the differences in the 2 test results of 1,000 flips each? Now in statistics, the runs or strings of consecutive heads or tails that produce the very different results are called aberrant runs. Strings that produce profits are called positive aberrant runs. Strings that produce losses are called negative aberrant runs. Now, no matter what the perceived winning percentage of a string of events is, positive and negative aberrant runs will happen, and they will skew your results. That's why you may be able to play the roulette wheel 100 times at a casino and make a tidy profit. Or how about this one? There are people that play lotto, even though it's like, 2,435 to 1 that you're going to win, but somebody does win. Even though the perceived winning percentage is vastly against you, somebody does win. Traders that talk about off-floor scalping for tiny profits are traders that continue to trade using a methodology that has a perceived winning percentage of less than 50% will generally fail. Generally. Let me show you how you can use a method with less than 50% chance of making a profit each time you trade and still be a profitable trader in the long run. This same method will also help you overcome the devastating effects of negative aberrant runs. And negative runs will happen. I don't care if you're me, Richard Dennis, who's a famous trader. Well, whoever's a famous trader to you. Let's assume it's not me. Risk reward was something that nobody talked about when I began trading, and it's not talked about enough today. People do focus on how they're going to increase their trade size as their accounts increase in value. That's really popular. There are various books about methods like fixed bet sizing, fixed fractional betting, and the Kelly formula, to name a few. But too often traders do not focus on their potential risk versus their potential reward when analyzing potential trades. So for example, if I'm going to play a game, if I give you $1, well, what's my potential reward? Is it $1? Is it 50 cents? Is it $5? Is it $500? That's going to change. I mean, if I'm going to play the lotto, I'm not going to play unless it's, $562 million. I mean, because I have almost no chance to win, right? Actually, I don't play the lotto at all. But now, my early mentor, Amos Hofstadter, was the father of risk reward and the co-founder of Commodities Corporation. He believed risk-reward was the engine that powered trading to profitability. And that showed in his phenomenal trading results over his more than 50 years as a professional trader. I happen to think he's one of the greatest traders of all time. Let's take a look at some risk-reward modeling. Let me take a drink of tea here, 1 second. If you do not know the probable outcome of a particular trading method, when you decide whether to take a trade or how much money to risk on a trade, it's called, this is actually a field of study, and actually one of the hotbeds of this is the University of Chicago. It's called hunch-centric betting. And although hunch-centric betting is certainly popular and likely accounts for an enormous proportion of actual real-world betting, including real-world decision-making on, you know, you all got this on, you know, Black Friday and Internet Monday or whatever the heck it was called, and then around Christmas, buy one, get one free, up to 80% off if you do X. You have to do hunch-centric betting. You have to decide whether or not it makes sense. Most people let their emotions do it. The trader must constantly generate hunches and interpret them into bets. And these bets, if you're using hunch-centric betting, they're likely to rely as much on moods and feelings as on science, which is a bad thing. What if you're in a bad mood? What if your feelings are all messed up? You're not going to have very good results. A similar problem is the amount risked relative to the potential amount a trader may or can win. Most traders are also hunch-centric when it comes to this line of thought. If they like the way a trade lines up, they're generally willing to risk more to maybe get less. They go, hey, everything looks cool. Yeah, you know what? I'm going to bet more. Many traders look at a potential trade and will risk more than their potential reward because their analysis of the trade setup tells them that it's a quote-unquote sure thing. Now, the truth is, most traders do not think about what they're risking versus their realistic potential profit if they're right in their analysis or if their hunch is correct. If someone comes up to you and asks you to play a game of chance that you had no idea what the game was and what the odds were, would you agree to risk $5 for an opportunity to make $1? Does that make any sense at all? Yet traders do this all the time, and actually with worse odds. Let's look at the results of 20 trades made using various risk-reward levels. Now, I'm going to use the risk outcome calculator that we gave away with our advanced risk management seminar from last year. This is one set of results. Results will vary. Each time you run this test, it runs 15 million iterations and then spits it out, the average. Okay, so every time I change the numbers, it's one of the outcomes. But if you ran it again, you get a different outcome. Okay, so let's take a look at some different possibilities. For these 20 trades, this is what the screen looks like. It's got 3 parts. Risk of ruin, which tells you if you go with these outcomes, what's the likelihood of blowing up your account? Position sizing, which is what we're going to look at today, or volatility, which helps you set stops. For these 20 trades, we have a 70% chance of having a winning trade. That sounds pretty good, huh? But for each dollar we risk, we can only make $1. You can't make $2. For every dollar you risk, you can only make $1. That's a risk reward of 1 to 1. So if we run this using a Monte Carlo simulation, it's called, runs it 15 million times and spits out the numbers. With a 70% winning percentage, this test of 20 trades gave us a losing month. 70% winning percentage, 20 trades gave us a losing month. Even with that high a winning rate, we experienced 4 losing trades in a row. So 70% sounds pretty good, but at 1 to 1, it doesn't mean very much. And there's a lot of traders that trade at less than 1 to 1 and think they're capable of, in the long run, making it work. Well, good luck with that. For these 20 trades here, we have a 50% chance of having a winning trade. But for each dollar we risk, we can only make $1, so 1 to 1. But now we're at now we're at 50% chance of winning. And remember, most of you, if not all of you, are under 50%. Most fund managers are at 50% or lower. There are very few people that are in the 50s, and almost nobody's in the 60s. Anybody that tells you that their annual winning percentage is 70, 80%, do yourself a favor, walk away. It's just not true. Now, at 50%, for each dollar we risk, we're only going to be able to make $1. Let's see how this goes. With a 50% winning percentage, this test of 20 trades gave us a losing month. With an equal winning rate, so 50%, we had a negative run of 5 losing trades in a row. Not much fun. They're only making 20 trades. 5 in a row, we're losers. And you can see it's pretty red here, folks. You know, we talked earlier about stops rolling forward or units. We lost 10 units, 10 go-no-goes this month. Not good. So if we're under 50%, our winning rate, and like I said, most of you are, most of the trading world is, how do we make money? Because we don't want to blow up. We want to stay in the game. This is where Amos's work came in. For these 20 trades, we're now going to have a same 50% chance of having a winning trade like we did before. But for each dollar we risk, we can now make up to $3. For each dollar we risk, we can now make $3. That gives us a risk reward of 3 to 1. That's a positive outcome, okay? Note that with a 50% winning percentage, this test of 20 trades gave us a nice profitable month. Look at, we rolled forward 13 stops for 13 go-no-go bars. We put those in our little safe. So on a $25,000 account, we made $3,440 and change. A very nice month. And with an equal winning rate, 50-50, we had 3 losing trades in a row. Okay, so even though we're 3 to 1, we still had 3 losers in a row. Not bad, but you know, you have to expect that you're going to have positive and negative runs. Look, we also look at our positive runs. Here we had 1, 2, 3, 4, 5 positive runs. Now let's increase it and see what happens. We're going to make it 70% chance. We have a 70% chance of having a winning trade. But for each dollar we risk, we can now make $3. So we have 3 to 1. And 3 to 1, by the way, is not that hard to find. At Market Geometry, in the midday sessions, in our breakfast with the master, evening with the master, in mentoring, basically we preach, you know, if you don't have 3 to 1 risk reward, you don't take the trade, period. Plan your trades. And this is one of the filters you need. So if you're at 70% chance of having a winning trade, and for each dollar you risk, you can now make $3. Let's take a look. 70% winning chance, 20 trades. This is a very profitable month. We move forward 36 stops or 36 go-no-goes into the safe. On a $25,000 account, we made $9,000. And we only had 2 losing trades in a row. And look at the winners. You can tell it's mostly black. I think for this one we had 2 winners and 2 losers, a winner, then 1 loser, and the rest were all winners. But this isn't unusual. You're not going to have 70% each month. Don't delude yourself. Don't let anybody tell you that that's likely to happen over and over and over. All right. So let's look at lower percentage winning months, yet a 3 to 1 risk reward. For these 20 trades, we have a 40% chance. Most of you are capable of being around 40%. For each dollar we risk, we can now make $3. So its risk reward is 3 to 1. Let's take a look. With a 40% winning percentage, this test of 20 trades gave us a winning month. we experienced 4 losing trades in a row, which is not bad. We only have a 40% winning chance, but take a look. 40%, we $25,000 account, we made $1,800.67, and we rolled forward 7 stops or 7 go-no-goes. Pretty good. Well, let's make it even worse. Let's say that you can only trade at 30%. Think it's possible to make money if you can only have 3 winners for every 10 times you trade? I'll tell you what, at 1-to-1, you don't have a chance. Let's take a look. For these 20 trades, we have a 30% chance of having a winning trade. But for each dollar we risk, we can now make $3, so we're at 3-to-1 still. Let's see what happens. With a 30% winning percentage, this test of 20 trades still gave us a winning month. But with a 30% winning rate, we experienced 6 losing. Now here's the bad news. We had 6 losers in a row. And you can see it's pretty negative looking. But we still made money. So it's a bumpy ride, but because each time we lost, when we had a winner, we made 3 times as much money, we can make money. I wouldn't like to operate at 30% winners. It wouldn't be much fun, but you can do it and you can make money. All right, these sample tests are meant to be representative of what happens to trading results when you vary the winning percentage, and more important, the amount risked versus the potential profit. Note that each time you run these simulations, the results are going to vary, just as the results will vary when you flip a coin 1,000 times in a row in 10 different simulations. I hope you understand a little bit better the risk-reward of a potential trade, that this is important, if not more important, than your winning percentage of the method you're using. If you only choose trades that have a risk-reward of better than 3-to-1, you're going to be well on your way to making and becoming a more consistently profitable trader. Okay, now we're going to move closer to a real trade, so you can perk up a little bit. The math's over. But please, do me a favor. Don't just gloss over the prior part. Spend some time when you watch the video, when you look at the slides, and make sure you understand how important risk-reward is. It's really one of the most important things in trading. All right, so Dr. Alan Andrews and Roger Babson were devotees of Sir Isaac Newton. Sir Isaac Newton was an alchemist. I don't know, some of you may remember last year I made you take the alchemy pledge. Most people think he was a physicist or the modern father of physics, but he was a mathematician and he was a physics student, but he really was an alchemist first. That's what he studied. He actually died from poisoning from all the, he was trying to turn tin and lead into gold. That's what he died from. The Emerald Tablet, which is one of the most revered documents in the Western world from history, has become synonymous with ancient wisdom. And Sir Isaac Newton's translation of this epic tome, and it's about alchemy, remains the authoritative version to this day. I'll show you what it looks like. We don't have to read the whole thing. You know, it's very flowery because this is from, we're not sure. We know it's at least 1,500 years old, but it might be 7,000 years old. They're still trying to date it. This is Newton's translation. And the most important part is actually the second line right here. That which is below is like that which is above, and that which is above is like that which is below. And if that sounds vaguely familiar to you, again, when you get the slide, if you want to read the rest, you can go back and read the rest. It's this. That which is below is like that which is above, and that which is above is like that which is below, was later transformed by Newton in his working papers as above, so below. And many scholars that, you know, their life is devoted to Sir Isaac Newton believe that it's the basis for his 3 laws of motion, as above, so below. Newton's third law of motion. That's what we're going to be interested in the most. You can see it there in the Latin. I'm not going to bother to try. I might hurt myself. My mother actually read and spoke Latin, but I've seen a few movies where people said it, and that's about it. But Sir Mott, in 1729, translated the Latin into, to every action, there's always an equal and opposite reaction, or the forces of two bodies on each other are always equal and are directed in opposite directions. That's Newton's third law of motion. And you should feel a little bit of as above, so below in here. How does Newton's third law of motion relate to median lines? Median lines they're my basic drawing tool. The common translation for Newton's third law is for every action there's an equal and opposite reaction. Let's see how that ties in. So this is a classic demonstration of for every action there's an equal reaction. I'm sure a lot of you have seen this. This was Scientific American in the early 1900s. You know, you pull the one ball back, you let it go, and it click, clack, click, clack, click, clack, click, clack. And if there wasn't a pull of gravity, and if there wasn't friction, this would go on effortlessly, endlessly. Opposite and equal reactions. In 1924, Dr. Alan Andrews took a handful of graduate students from MIT's math department and began 4 years of hands-on experiments dealing directly with Sir Isaac Newton's ideas and the movements of the stock market. Alan Andrews' father owned a firm called Frank Andrews & Son. It was a brokerage firm, but he wanted to be a physicist. We know from our documents of the time, the group experimented with strings stretched from one pin to another on boards. They plucked the string. The strings were then plucked, and the string's length of movements in the opposite direction was carefully recorded over and over again. They locked them in a room for 4 years to do this kind of stuff. They also experimented with wooden balls on one end of a piece of stretchy string tied to a pin, and when the wooden balls were pulled back a certain distance and released, the length of travel was then recorded. These experiments were attempts to validate equal action and reaction. Alan Andrews, like myself, I have a doctorate in physics, math as well, believed in, show me type of physics. In other words, it's not enough that he understood the principles. He wanted to validate it with actual physical models. So they did all kinds of interesting things. And actually own the papers. It's over 1 million pages from back in the 20s when they did all this stuff. And these poor graduate students, all the things they made them do. Now, many of you have seen sine waves. And the sine waves go back into the late 1700s, early 1800s. And they deal with physics. And specifically astrophysics. As a thermodynamics professor, Andrews was certainly familiar with sine waves when he came out of MIT. And you're going to see in a minute that this looks strikingly familiar to market movements. Babson was famous for his economics firm. In fact, and he formed Babson's College, which is now Babson University. His economics forecasting firm is still alive and well today, and now actually his great-grandson is the president and taken over. And he's famous for something called Babson charts. So this is pretty much what they look like. And what he did was he would take a look at the he had a predictor of the economy, and he would take a look at the value area under here. He'd do the calculus of the size of the area under here, and then when price crossed the line, he would predict by the size of the amount underneath here how far the growth would be before it would turn down. Same thing with the growth above here would predict down below. So even he was doing as above, down, so below. And you can see it looks an awful lot like a sine wave, doesn't it? So it's quite easy to see the relationship between Basson charts and sine waves. This is a mathematical representation of a sine wave. You don't have to do any of this work. Don't worry about it. Don't think about it. This is what a sine wave looks like. And actually, for those of you that are in market geometry, this is a three-dimensional representation. It's a sine wave that's actually rotating in three-dimensional space. But that's neither here nor there. If you ever wondered what it looked like, that's what it looks like. All right. Now, there's also the method of least squares grew out of the fields of astronomy in the early 1800s. You guys have seen these now in charting programs. The linear fit that matches the pattern of a set of paired data closely is called the least squares linear regression line. If you look closely at the slope line above, it's a curve fit center line. Andrews would take reaction lines and produce median lines from their concepts in the 1940s as a mathematically sound method to project the probable path of price forward in price and time. So we're getting closer and closer to what median lines are. This would be the center line in an action-reaction line. So in an action-reaction line, we'd find the center line, then we find the outlier or the edge, and that would be the action, and we flip it over and do the other side. That would give us the reaction, which would give us a probable path. But it's not quite as easy to do as median lines. So from theory to practice, linear regression lines, sine waves, alchemy, and physics give us median lines. Let's see how that happens. Let's start out with a basic sine wave function plotted with an upward slope. You remember this image. Now here's a basic median line. It's got alternating pivots. It always has alternating pivots, a low, a high, and a low. And we also always want to know where is the middle of this second and third pivot. It's called the bisector, the BC. And we're going to connect the first pivot to the center of the second and third pivots. That's what gives us the slope of the median line. Then we just connect them to the B pivot and the C pivot. That's what gives us our median line. You don't have to worry about that these days because charting packages now do it automatically. How is it related to median lines? Or excuse me, sine waves and linear regressions? Well, here's a sine wave function on a median line. And you can see that's what price looks like when it's a good median line. It fluctuates from one edge to the other, and the median line's job is to show you where price is likely to run out of energy and when it's back in balance, which is at the center. Now, as with a sine wave function, as with a linear regression set, price fluctuates. It's our job to use our tools to project the probable path of these fluctuations and take advantage of them. That's what we do as traders. Now, we're going to take a look at my favorite way to use median lines to take advantage of the fluctuation of price. Here's an image of basic price action on a currency future, yen. Just take a look. Take a second. Take a look at the pattern. Take a look at the bars. I purposely kept out the scale and the dates because I want you to pay attention to price action. I want you to just look at price. I want you to look at what's going on. I want you to look at the opens and closes of the bars, the size of the bars. Over here is average true range. I've got a 55-period average true range and a 200-period average true range because I want to know how volatile things are and if volatility goes up or down as I trade. All right? So here's our beginning. Now, let's look at it again. Just imagine what a linear regression line would look like, or as Andrews would say, a center line. This is relatively equidistant to the extremes, and it runs through and touches a lot of important areas in this data. So this is a potential center line, or it might be a least squared linear regression line. And as I look at price action, I've been doing so many charts, I automatically just see these. Maybe you have to draw them or have your charting package draw them. I can just see them. All right? So now I'm going to take this same price action. Now let me annotate it and show you the various important pieces of market structure that I see and that I think about as I'm analyzing what's in front of me before the market, before I get ready to trade, before I even get ready to do more analysis. First of all, I got a significant low here. Price is coming down. It clumped. You can see all the closes at the same area. Left one significant low. Then it started to break highs. Ran up here, even took out this high. Pulled back, made a new high. Pulled back, made a new high. Then it began to stair-step lower. Left a low. Ran all the way back up here and left double tops. At that point, I connected this high, this low, and this low, just ran the line down. I flipped it over off of the highest high, and this is really price kind of cascading lower. But all of a sudden, we leave a higher low with these double bottoms, and then we break out of this cascade lower. See it? This is how we were traveling. Now we've broken out. We've got two closes, and we take out this prior swing high, which was double tops. So as I look at it, this looks like a change in behavior to me. And on top of that, not only a change in behavior to the upside, we left two higher lows. I can already see the median line for this price action. Can you see it? Take a moment and just take a look. I helped you a little bit by putting the pivots. See if you can visualize it. I've got pivot B, pivot C. Before I show you, we're going to take pivot B, pivot C. We're going to connect them. Again, your charting program will do it for you, but it's good if you can visualize it first. Pivot B connected to pivot C. Find the center. Connect it back to pivot A. That's going to be the slope. Connect the slope to B. Connect the slope to C. You'll have the three lines. This will be your tail. The fork will be out here. Let's see what it looks like. Well, it looks like this, as a matter of fact. I cleared the bars off the chart, and this is the median line that I see. A, B, C, upper parallel, median line, lower parallel, and there's the bisect of the BC pivot. Let's put the bars back on. There's the bars back on. Hopefully that's what you saw, or something close to it. So let's take a look at it. I draw the traditional median line on the chart, and I'm just using the low, the high, and the low. There's no art here. Now, it would be too early for me to try and take a trade right here. I don't have any sign of strength. It still looks like price is heading lower. Then all of a sudden, price heads higher. Now, one of the statistics that Andrews has, it was a theory, it's now been proven, 80% of the time when price comes off of the lower parallel, it will make the median line. 80% of the time. It's very powerful. If it breaks the median line, 80% of the time it's going to the upper parallel. If it turns and heads lower from this median line, 80% of the time it's going to make this lower parallel. Andrews called this, he said it this way. 80% of the time, price will make its next most likely line. So whichever line it was heading toward, 80% of the time, if you used alternate pivots like this, it would hit its next most likely line. So my eyes, my intuition, the probable center line, and the median line tell me that there may be an opportunity for a long trade here. But I need to watch for price action to unfold further. I'm not ready to trade yet. I'm stalking a potential long entry. I want a high probability entry, so I'm going to be examining specific things if price tests this lower parallel. I'm not going to chase price. I'm not interested in trading up here. I want price to pull back to an extreme. But if it pulls back to extreme, it's got to pull back in a certain way, or I'm not going to be interested. I'm going to show you, we talk about risk reward. That's the number one, that's the first thing that I think is, my number one basic. And the second thing is how I use something that we're going to call a test and a retest to really up my odds when I trade. So upon reaching the median line or its parallels, price will do one of three things. It's going to reverse, congest, or accelerate, which means zooming the line in the process. Price rarely congests, only about 10% of the time. But by using a test and retest strategy, acceleration can be ruled out about 80% of the time. But take a look here. Price is pulling back. If I simply put in a limit buy order to buy at the lower parallel without waiting for price to test it, I risk price zooming through it as it's going on now. And if price breaks through the swing low here, stop sell orders are going to be executed, and it's going to push price further and further against me. I'd rather employ a higher probability entry technique, the test and retest entry, something that I put together, which helps rule out these zooms. So price tests the lower parallel. This is real now. Price tests the lower parallel. Since price closed 11 ticks higher than the test, this test has good separation. I like it to have at least 5 to 7 ticks above the test. So it closed at 11, it meets my criteria. By waiting for a test with good separation, I increase the likelihood that price will either congest or reverse at the lower parallel instead of plunging lower. I don't want it to plunge lower. If it congests, it'll either then turn higher or I can work my way out of the position. But I don't like getting in and then just being stopped out of the next bar. And I'd like to limit that as much as possible. So with this bar, I like the separation on the test of the lower parallel. I want to try and buy a retest of the lower parallel. I need a proper stop loss order. I want my stop loss order to be at least 5 to 7 ticks below major structure. Major structure is right here. The average true range over here tells me I need to use at least a 25 tick stop. Okay, look at the average true range. It's at 20. I want to be at least 5 ticks past the largest of the two average true ranges. That's called noise. Excuse me. Checking the chart, I see that if I place a stop order 25 ticks below my entry, it's not only 5 ticks past the ATR, it's also correctly below the major structure, at least 5 ticks. So here's my 25 tick go, no go bar, which we talked about. Here's my potential entry. I'm not in yet. But if I put my stop directly underneath this C pivot by at least 5 pips, I can use a 25 tick go, no go bar, and I can put in a limit buy order for the next bar. But before I can enter orders, I have to have a profit target. Choosing a realistic profit target is a key part of framing any potential trade. Most people trade without a profit target. Instead, they're going to go along for the ride until the ride's over. You know, at some of the seminars that I give or when I'm on a panel, I have people that argue with me all the time. You should never have a profit target. You should always just let your winners run. Well, that's just baloney. Similarly, most people do not look at the potential risk reward of their trades. Framing trades with risk rewards greater than 3 to 1 is the key to improving your profitability and will help decrease negative aberrant runs as well as helping you survive them. So if you only take trades of 3 to 1 or better, you are going to be so far ahead of the pack. Your trading is going to be so much better. So I'm taking a look, and what do I think? Things have been in this congestion for a long period of time. I think it's likely that if we take out this high, we're not going to stop here at the prior highs. We're going to go up to the, Andrew says 80% probability we'll make it to the median line. If that gets broken, 80% probability will go to the upper parallel. I think that's where we're headed. So if I just go to the median line, I'm risking 25 ticks. It nets me 69 ticks if I hit it on the very next bar, which is 2.8 to 1. It's pretty close to 3 to 1, but it's not 3 to 1. If it takes 5 or 6 bars, it'll probably be at 3 to 1. If I wait for a test of the upper parallel, on the very next bar, it's 127 ticks, which is a risk-reward of 5 to 1. So this certainly meets my criteria. So I'm going to try and get long at this next bar. I'm going to use a 25-tick stop. That's my go, no-go bar. And if I get filled, my profit target is going to be up here at the upper parallel. So here we go. Price retests the lower parallel, and it fills my limit buy order. 3 bars later, price zooms the median line right here and the prior swing high. Now, price should come back and retest this median line. In fact, Andrew says with 80% probability, if it zooms the median line or one of the other lines, it's going to come back and retest. Perhaps if it does, it'll leave market structure, and I'll be able to hide a profit stop underneath this congestion area. My profit target remains the upper parallel. Now remember, I'm long against upsloping lines, which means I have to keep moving my profit target higher. And as time goes on, I'm going to make more money. Okay? Price finally retests the median line after forming a sloped coil. If you turn your head to the left right now, please do so. You'll see the simple support formed by this coil right at the median line. It's a sloping median line. Turn it to the left, you'll see that this is just a coil or a range. Just happens to have a slope. If price can stay above the median line, it will eventually work its way above the top of the coil and head towards the profit target at the upper parallel. And remember, we talked about this. Time is on my side here. The longer it takes, as long as I don't get stopped out, the more money I'm actually going to make, because I'm going to keep moving my profit target up this line, which is positively sloped as time goes on, as we go to the right. Price breaks above the sloped coil, making a new high for the move. As the bar closes, I enter a profit stop order 10 ticks below this clump low at the coil just below the median line. I measure where price would currently intersect with the upper parallel. I just run my cursor up and then update my profit order. If I get profit stopped out right here, I'll have made 72 ticks. So I risk 25, and even if I get profit stopped out, I'll have made 72 ticks, so that's fine. Note that the larger the two average true ranges is getting larger, which means the volatility has been picking up as well. Okay, once price broke above the slope coil, it went straight up, hitting my profit target at the upper parallel right here. The initial stop loss was 25 ticks, and the final profit was 192 ticks, which is a realized risk reward of 7.68 to 1. Pretty good. I wanted to show this trade to highlight what I consider to be my favorite and most often used techniques. 1, waiting for a high probability setup. That's a test and retest entry. 2, using a standardized equal maximum risk on each trade. That's go, no goes. In other words, I'm always going to risk, for example, in this example, for a $25,000 account, each time I trade, I'm going to risk $250. 3, divide your capital into non-monetary units and roll these units forward and think about them that way. Don't think about dollars and cents. Think about stops rolled forward. Think about go, no goes. Think about units, but don't think about dollars and cents. And of course, 4, the absolute importance of keeping the ratio of the money you risk to the money you expect to make from your profits as high as possible. That's called the risk-reward ratio. Now, so this is a very good example of my bread and butter day in and day out trading technique. I'd say 90% of the time I use all these techniques in the trades that I do. It's much easier to trade when you think in terms of standard units rather than money, and I find the higher probability test and retest entry my favorite. Even if I'm trading against, let's say, a trend line, I'll use a test and retest. It doesn't have to be a median line or action-reaction lines. I'll use a test-retest. I find that the test-retest gives me a higher probability, and it keeps the risk-reward ratio as high as possible, and certainly over 3 to 1. If I keep my risk-reward ratio over 3 to 1, it's going to improve your rating. If I take out my last 2 years, which are triple-digit years out of my statistics because they skew them, and I just use up until 2 years ago, so the prior 40 years of trading, my actual risk-reward ratio is over 3.6 to 1. That's one reason why I'm such a good trader, is I don't take trades under 3 to 1. That will greatly improve your trading. If you could just think about this and use it as a filter for trades, it'll filter out so many bad trades. And that, as they say, is the presentation. I showed you what I use 90% of the time, and hopefully, if you do a little bit of studying, you'll pick up some techniques here that will help you for 2014. Cynthia?
Tim, I am right here. I am right here, and what I've just done is enabled the chat panel again for everyone. I could almost feel everyone chomping at the bit with questions. So if you do have questions for Tim, everyone, now's a great time to enter them into the chat panel. Please, though, take a look. Notice the send to box. If you would, use the drop-down arrow, and you can send your questions to all participants. That way, we'll all be able to read and benefit from the questions that you do have. Okay, there's also a few questions that have come in previously, Tim, that I did want to, as people are writing their questions, I wanted to get you started. A couple of questions had come in earlier about that risk-reward calculator that you had shown early on in the session. Is that available?
It's available if you take the course or get the DVD. It's complicated enough you would need instruction with it anyway, but yeah, we have it on the website.
Okay, excellent. Well, we can.
I'm not. You know what, Cynthia? Yeah, and that's an awkward moment. Let me explain. Cynthia and I'm sure it's the same with everybody that works with Cynthia, but Cynthia and I go back. I don't want to date you, darling, but 2005. And one thing that we agreed right at the beginning is I'm never here to sell anything. I don't try and sell books. I don't try and sell seminars, memberships, nothing. I'm here to help educate traders just like you are, and that's why I like you the best is you're not here to sell IB. You're here to help people learn how to trade better. So, you know, if there was a pregnant pause, it was because I don't want to advertise anything that we're selling. That's not the point.
Okay, well, what I will do then is just simply say, if you're interested, check out Tim's websites here, and you can look a little bit further through. Okay, looks like I'm getting the questions are coming into me. I'm not seeing them go into the...
Yeah, no, I'm getting them.
Oh, you are getting them. I also have a favor to ask those who are sending it to all attendees. Presenters can't see that, so if you did happen to send your message to all attendees, if you would either select all panelists or all participants. That way, we'll be able to see those questions and respond. So I'm going to be quiet now, Tim, because I know a lot are coming in. So go ahead and see what you can handle.
I was hoping that you were going to talk for 10 minutes and I could be quiet, but okay. All right, here we go. Couple things. All right, so those were 20-minute bars on the yen, and they were yen futures. And like I said, I purposely didn't put the date down. I don't want you to focus on that. I don't want you to go back and try and recreate it. Instead, I want you to take a look at the techniques, and I want to keep them abstract. And I purposely did that. You know, last time I had somebody ask me, you know, my data doesn't line up perfectly with yours, or what feed are you using? That's not what's important here. What's important are the techniques. Or the methodology we're using. Armand's asked about the ORE method. The ORE method is actually, I hate to say this, it's baloney. There's a gentleman that tries to sell Dr. Andrews' original course that we give away for free, once we started giving it away for free, tries to sell it for $5,000. He comes up on a regular basis with different things, and this is about as far as I'm going to go with it. And he's trying to sell the ORE method now for $3,200 that he says is a Roger Babson thing. It's all crap. Save your money, okay? I mean, life's too short. You can go, and I've said this before, anything that I teach and people pay for, you can find on our website for free. Anything that Andrew's taught, anything that Babson taught, and now finally that the Commodities Corporation codicils are lifted, anything that AIM has taught, you're going to be able to find free at Market Geometry. If you want to attend the classes, that's great. You want to do DVDs, that's fine, but that's not what we're here for. We're here to help people learn how to trade. At what point in price development after price forms the C-pivot does the probability 80% apply? That's a great name, by the way. Or how do you confirm validity of a median line after a C-pivot formation? In point of fact, there's been 3 doctoral theses that were written at some good universities, some fine universities, documenting this. You can do it any way you want. You can just, the moment it touches the median line, you can, in my first book, what I did was 27 boring pages of every high, low, high, low, high, low, et cetera, of the E-mini S&P. I just picked it randomly and followed it out for 27 pages of charts. And there are numerous tests on each one of the pages. And the statistics for that happen to be 87% probability. You can either make it break a high on the way up, or you can just actually, once it tests it, just count it. It doesn't matter. You're still going to end up somewhere between 72% and 87%, and the median is 80. Is separation the only indicator of large buyers and sellers? Actually, separation is not an indication of large buyers and sellers. It just means that price has run out of downside or upside, directional energy. That's what it means. There's no, it's not a relationship between multiple bars. Hi, Mark. How are you? Let's see. Please elaborate on the time or distance requirement for test and retest. Well, when I intraday trade, that's a good question. When I intraday trade, if I have a test and I'm using test and retest, after 5 bars, I consider the test to be stale if it hasn't retested, and then I count the next time it touches the median line or its parallel as a new test, and then I require it to retest again. So intraday, 5 bars. Tony, hi Tony, how are you? What time frame were you using? That was 20 minutes. What was the total time of the trade? We go back and count it. Hang on a second. There you go. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 16, 17, 18, 19, 20, 21, 22, 23 20-minute periods. Somebody can do the math. I'm tired from talking. It's not a very long trade. What time frame do you prefer or recommend when trading currencies? Well, it depends on what I'm doing. If I'm portfolio trading, I do daily, weeklies, monthlies, or maybe 240s. If I'm intraday trading, I really like 20 minutes. There are times when I go down to tick charts, but I use pretty hefty tick charts. They're similar to 20 minutes. Intraday or trades that are less than 3 days, I like 20 minutes. Do I consider momentum? No. Sorry to be so short, but no, I don't. This may be redundant. My apologies. Can we get copies of this? Yep. Don't worry about it. As you exit, you're going to get this nice little thing that says, would you like a PDF copy? And just say yes, and it automatically will be there for you to either look at and or save. If you forget, in about 2 hours or 3 hours, Cynthia is going to send you an email. It's going to show you how to get to the recording of today's session. And then once you're there, you get the same opportunity. You can always get the slides, and you can always watch the recording over and over and over. So that's great. And some of our recordings go back, and our slides go back to 2008. I know Pete said 2012. We go all the way back to 2008. Let's see.
2007, actually.
2007. Thank you. Yeah, somewhere we lost a couple of years there, but we kept most of them. Please elaborate on how much of your account size can be at risk, risking no more than a fixed 1% percentage at any given time. 10% or 10 positions? Me? No. I would suggest to you, Rick, that you risk, I mean, if you have a really small account, $10,000, it's tough to risk only 1% because it's going to be hard to trade. But I really wouldn't get too much above 2 or 3%. And in terms of 10% with 10 positions, no. First of all, if you have 10 positions on, you're kidding yourself. You're not going to be able to focus. I would suggest really that you limit yourself to about 3 positions, unless you're a professional portfolio trader. And I really like the number. I'll tell you what works really well for me on intraday trading or on smaller accounts. I really like 1.6%. Something around there is just fine. And I know my partner uses something similar. He's 2-ish or under 2%. Ahmad, I didn't see your question, so please repeat it, and then I'll comment. What are the indicators in price of large buyers and sellers? Well, it's simply price action, looking at the bars. We didn't show it today, but if you go back and look at last month's, just go back and register. You know, I don't know if you guys know this. Cynthia will show you in about 15 or 20 minutes when we're further on the questions. She's going to show you the educational page, and she'll show you how to go back and register and look at prior events, okay? And if you go back to last month's events, we did a wash and rinse. That's a wonderful example of whales being in the water. When I say yar, there be whales, whales are people like me. At any one time, at any point in time, there's 3 or 4 people, 3 or 4 traders that are the largest traders in any one market. Those are the whales. Those are the people that'll run your stops. Those are the people that'll, you know, that have enough to do that they end up causing support or resistance. Those are whales. And one of the signs is, you know, things like washes and rinses, multi-pivot lines where you get multiple touches, multiple tops and bottoms, and then all of a sudden price takes off from there. Those are the types of things we'll be looking for. How does median lines work with Renko? Works fine. Works with Renko. Works with market profile. Works with point and figure. You choose. It doesn't matter. Any price action. As Andrew said, anything that fluctuates, including he had a long argument with the Miami Herald, and he did for one whole year. He forecasted the weather 1 week out against the weather forecaster for the Miami Herald, and he used median lines. And he beat the pants off the poor meteorologist. Let's see. Hi, Steve. How are you? I was wondering if you have a tool that automatically draws median lines for you. Or if, yeah, there is. Again, I'm not trying to sell anything, but I'll tell you, if you look up this, Steve, market geometrics, just go to marketgeometrics.com. There is a tool there that automatically draws median lines for you. That actually, I was involved in doing the math and setting the protocol. And in disclosure, as a disclosure, I am one of the owners. I actually would prefer not to be. I don't want to sell anything, to be honest. But anyway, if you want that tool, it's there. It's there for you. You can go get it. Let's see. Wondering if you have time, if you could answer my email to you. Oh, you know what, Steve? Would you resend it to me? My last 3 or 4 weeks, I have been basically in bed. How about that? Other than I took 5 days off and went to Tucson and sat around in the sun to just warm up and see if I could burn off some of this virus. Michael says, if using daily charts, would you count 5 days for a test or retest? That's a good question. No, dailies I'm going to give it, you know, I mean, it depends on how many days you're looking at, but, you know, now you're going to be talking about 15 or 20 days. Okay, it's relative to how many days you're going to look at. But intraday, I'm just never go more than 5. David Jones, what would be the best educational path to learn your process? For example, what DVD set should I use first? Oh, God. No way to answer without selling. If I were you, David, the very first thing I would do is I would come and read all the free material at marketgeometry.com. That's the very first thing I would do. I wouldn't spend a nickel. That'll tell you, first of all, whether or not you like the way that we teach. There's over 100 articles. There's a bunch of videos. There's all kinds of Excel tools that'll help you. Then, if you like that, I probably would take I would sign up for 1 month of premium midday sessions, which we do live, where we teach live, and we do a basic one day. Another day we might do more advanced. And then at that point, you can take a look. If you get that far and you still like us, or myself and my partner Shane, you still like what's going on, then drop me an email and say, Tim, I'm in the midday sessions and I want to go further. What do you think I should do? Because there's all kinds of different things. We do DVDs. We do something called Breakfast with a Master, which is every morning at 6 a.m. You can sit with me for 2 hours. We go over, and this morning we spent 2.5 hours, and we're in a live trade right now, and I don't have a live chart up in front of me, but we're long the U.S. dollar against Canada, and we've got over $2,000 locked in at the profit stop. We'll see how it plays out the rest of the day. We do, that's another way. Evening with the Master, we do that twice a month. That's for portfolio trades, all kinds of things. So I don't really know what to do. David says, thank you for a non-egotistical approach to teaching. Well, I appreciate it. Remember, I teach at a university. If I showed up with an ego, the graduate students would beat it out of me pretty darn fast because they're pretty intelligent. How do I handle economic data releases and news? Asked Bob. I take a sheet, and I have a degree. I have a PhD in economics too. There's no edge in trading the data anymore. So what I do is I take a sheet that has all the times and days, and then I take a ruler and I put it next to where the description is, and I rip off the description and I throw away the description. So then I know that at 7 o'clock on today something's coming out, at 8:30 there's something coming out, at 10 o'clock there's something coming out. And then if I'm about ready to get into a trade, I just look at it and say, there's something coming out in 5 minutes, I might want to just wait 5 minutes to make a decision. If I'm already in a trade, I might look at it and say, you know what, I've got plenty of profit, and I've got a profit stop in, and I've got a profit target in, so I'm not going to worry about it. If I'm at break even, I might consider just closing the trade, but generally, I just don't worry about news. Do I think trading intraday is more risky than trading 4-hour and daily, et cetera? Ahmed, there you are. No, not particularly. I do think it's easier. Most people won't like to hear this. I think it's easier to pick out the pivots and the important highs and lows on dailies, weeklies, and monthlies than it is on intraday, faster twitch things, because there's more noise and there are a lot more pivots on 20-minute or 10-tick or whatever. So, if you're looking for things that are not noisy, you're going to be better off looking at 240s or dailies, something like that. That's why fund managers tend to look at 240s or dailies, weeklies, and monthlies. Bob says, how do you handle economic, well, I just did that one. Do you think trading, I must be behind. At the beginning, you said 250 risk gives 1,000 chances in 250 in a $25,000 account, but it should be 100, right? Well, let's see. Let me get my handy-dandy calculator here. 250 times 10 is 25. You are correct. Thank you. My bad for not doing my math. AJ says, really appreciate you not selling here. I get hits many times a day. Yeah, you know what? I try to not, look, it's a fine line. We are teaching people, but that's not what I do for a living. Okay, I manage money for the wealthiest chunks of money in the world. That's what I do for a living. But I'm trying to give back. Amos helped me. Dr. Andrews helped me. Dr. Andrews charged me $1,000 a month. So what? Each trade I made was worth a lot more than that. But that being said, I'd like to give back. I'm in the legacy portion. Okay, I'll be 56 on the 18th of January, and when I'm gone, I'd like a body of work. I'd like people to remember that I was here and that I helped them, and hopefully a lot of you will then be giving back to other people. Thomas says, after the 0 to 4 count has been established, can I use it as an entry trade? No. No, that also is hokum. 0 to 4 is, you can count, those of you that don't know what we're talking about, P0, P1, P0, those are pivot counts. P0 to P4 is a line that if it's violated, it will tell you that the trend has ended. It doesn't mean a new trend's begun. It also does not provide support or resistance, okay? It's only an indicator sign, that's all. So that is also another piece of hokum that's out there. Just leave it alone. I would just use a median line or and or market structure, and it's just an indication of what's going on with the trend. Do I ever use volume to determine if the move is legit like Wyckoff would do? Well, Phil, no, because as a large trader, I can tell you that I know how to hide my volume. My volume doesn't, I can decide that my volume is not going to show up in today's statistics. And if I know how to do it, you can bet your boots that a lot of other whales know how to do it as well. So I'm sorry for all the people that follow Wyckoff. The volume figures, they're baloney. I know there's more questions. No? You want to take a break here, Cynthia, and show me the educational page?
Well, what I can do, I also want to show the educational page, but I do have a piece of business that I've already skipped over. I was still waiting for your question in the Q&A session. So I'm going to take this moment right now, but before I do, I want to let everyone know.
Wait, this isn't the poll, is it?
It is.
Oh, wait, stop. Don't start yet. Hang on. See, I'm going to front runner. She's going to do a poll here, and it's only 45 seconds, so you need to know what's coming up, okay? And she never takes care of herself. Listen to me very carefully. Nobody in the industry does a better job than Cynthia bringing quality education. I'm not just talking about me, okay? There's all kinds of cool people that come and talk for the CME group and for Cynthia, okay? And, yeah, I think people are sending them to attendees, but not to all participants. Please send your questions to all participants, guys. Otherwise, I can't see them. All right, so Cynthia's about to open up a poll. And when she opens up this poll in the center, there's going to be a little place where you can write. Make sure you write in there either webinars or Cynthia. Okay, because that'll help her with management. Okay, now go ahead, Cynthia. Now you're free to go.
Thank you, Tim. And Tim is right. My management team does ask that I do this in each event to make sure that the information we're bringing to you is relevant to your trading needs. We find that educated traders make the best clients. So that's the purpose behind here. But notice that there's 3 short questions and 2 are multiple choice. So make your selection. Now, number 2 has an input field. Don't put your questions there. That's a great place for comments or suggestions. If you do have a question, hold on. Poll will end in about 12 seconds, so we'll get back into the chat panel. Now, just make sure after you make that selection, though, that you do click the Submit button that's in the lower right-hand corner of the box. That allows me to actually compile that information. Okay, poll did end, everyone. Thank you very much for that feedback. It really is helpful for the program. Now, also, you'll find that the polling panel actually has covered up the chat panel. So use the X that's included in that title bar where you can collapse the polling panel and then simply double-click on chat and it will reopen it up. Now, when I did reactivate that chat panel, initially I didn't have all participants activated. I caught up with that thanks to everyone who's made that mention. I did catch up with that, but if you haven't found it, simply use the Send To box in the bottom of the chat panel and scroll all the way down to the bottom where you will see all participants. So have you seen any additional questions come in, Tim?
Yep, all kinds.
I thought so.
All right. Hopefully you guys all gave Cynthia her props, and because I'll tell you, I only give presentations here other than Stanford and MIT and University of Chicago. And the reason why is because Cynthia, as I said, she's just here to help educate people. Nobody's trying to sell anything, and that's very unique in this world. And I really think what she's put together with the CME is unique, and I'm so proud to be a part of it. Let's see. I use a charting site that shows the normal 3 median lines, meaning the upper parallel, the lower parallel, and the median is what he's talking about, plus 2 other lines halfway between. We call those quartiles between the midline and the upper and lower lines. I see the price often hovers around the 2 additional lines. Can you comment? Yes. Statistically, there's no meaning. That center line that they have in there, and there's a couple people that don't know anything about median lines that try and teach that. It's statistically meaningless. You'd be better off when you see it make a couple touches in that area to draw something called a sliding parallel. It has the same slope, and draw it in then, and because it won't be at exactly halfway in between. It might be, same thing. Some people actually use, instead of halfway, they use the fib numbers. Same thing. It's all nonsense. Okay, it's just not true. Sorry. can you please review how you set your initial stop? You were using ticks, but how would you set that up on a daily chart using 1.5 ATRs? Well, it's simple, David. I would look at the average true range of dailies. And what I do is on a portfolio basis, I say, okay, look, I'm going to risk X on, let's say, bonds. Okay, so I'll take a look at the average true range of bonds, and I'll say, look, to survive the move against the trend, 80% of the time, I have to be X amount of ticks above these swing highs or swing lows. Once I find that out, I know what size stop I'm going to use in the bonds. That tells me a dollar amount. Then I know that if I'm going to trade one bond, I'm going to trade X amount of contracts in the corn or X number of dollars against the euro. Very simple. How long does it usually take you to enter a portfolio position? Andre, depends on the market. I mean, I trade tens of billions of dollars at a time. So, but sometimes it's almost instantaneous. Sometimes it can take me hours to work into it. Depends on the conditions of the market. Intraday, the good news is I'm very skilled at execution, so usually it's not a problem. If I'm in a market where it is going to be a problem, I generally don't put the portfolio, my clients, I keep them out of the market. I don't want them in a market that's too thin for the size of what we're trading. That means that, I'd be over leveraged, and when I tried to get out, I'd be swamped. So I'm very mindful when I trade. Let's see. I had a good one here. Here you go. Frederick, this is a great question, and thank you for being honest. I tried to trade for a living and found that the biggest issue turned out to be mental. Any suggestions to the people or me about overcoming the mental concerns? Yeah. Look at my motto. Master your tools, master yourself. The hardest thing to do is not to learn how to use median lines, not to learn how to do risk reward, not to learn anything other than mastering yourself. The hardest thing is to be disciplined. Every way, shape, and form. You need to be completely disciplined. I've heard myself described by some of my investors as a discretionary systematic trader. Okay, that's fine. What it means basically is I'm very repetitive. I do things the same way every time, okay? I don't break my rules. If I break a rule, I take a month off from trading. I mean, you really have to be that disciplined. Remember, every time you trade in these markets, you're trading against the very best traders in the world, every time. So the best thing I can tell you is surround yourself. For example, if you go to our website, go to free resources and look on there, you'll find some routines in Excel and on Word that'll help you with a series of questions. How much am I willing to lose before I stop trading for the day? How much am I willing to lose for the week before I stop trading for the week? How many trades in a row am I willing to, losers in a row am I willing to take before I stop trading? And you want to fill all these out. Then you want to keep it on the desk in front of you. And also, every time you trade, we have a trade sheet that you can have free. Answer all the questions before you trade. And then, as you start to waver, which is generally what happens, Frederick, people get into trades, then they get a little nervous about the money or whatever. You can take the trade plan and read it and go, oh, okay, I'm all right, I understand where I'm at now, and get right back on track. The hardest thing, again, is mastering yourself. I'm not going to tell you about hypnotism or meditation or any of those types of things. Discipline. You're going to have to learn to discipline yourself. How much of your charting, it's coming in so fast now that I'm having trouble scrolling. How much of your charting is straight use a pitchfork tool, and how much is seeing a center line, median line, and then setting action reaction lines off of it from the nearest high or low pivot? I'm honest when I'm telling you that 90% of the time, I showed you what I did 90% of the time. I'm being absolutely honest. It's action reaction lines are a subset of, median lines are a subset of action reaction lines. Linear regression lines are a subset of action reaction lines. So the two are interrelated. median lines have a mathematical probability. Action-reaction lines do not until they're proven. I do use action-reaction lines, don't get me wrong. You'll often see me, for example, in this morning session, I connected, 5 or 6 slope tops, and I called that frequency, and later on I ended up using that, but then later on, when I actually traded, I had that frequency, but I ended up choosing the median line. Why? Because I know the statistics behind the median line. If I have my choice, I'll take the median line. It's got mathematics built in. Let's see. For portfolio trading on a daily time frame, how quickly should a retest occur after a test? Well, I already said 15 bars is not unusual. It's much more important in the intraday because you'll get a lot of noise and you'll get a lot of pivots. On dailies, weeklies, and monthlies, you don't get that many pivots. So sometimes you have to wait a while for the retest. Okay, Bob says, why do you not like 1-hour charts? It's not that I don't dislike them. In fact, in the 80s, they were the charts to trade. But now, portfolio guys are trading 240-minute trades. That's the gold standard, okay? And the reason why is it's one half of the New York day, second half of the New York day, one half of the Tokyo day, second half of the Tokyo day, et cetera, et cetera. Well, if you divide that, then when they go down to a smaller time frame, they go to 20 minutes. There's nothing wrong with 1 hour. There's nothing wrong with 120 minutes. If it fits your style, Bob, go ahead. There's plenty of people that I mentor that trade hourlies. In fact, we had a guy that actually donated his entire 2013 trades and statistics, and they were all hourly based. They're fine. That's fine. There's no problem with that. Is there any other methodology besides median lines that has merit? One of my closest friends has made over $2 billion trading. His personal money, $2 billion. And he does use median lines. He took my seminar at the Mercantile Exchange in 2003, the first seminar I ever gave at the Chicago Mercantile Exchange. I did 3,500 traders there. Barbara helped me set that up at the Board of Trade and at the Chicago Mercantile Exchange. And he's been my friend since 1980. And but his number one tool is point and figure. I'm not going to lie to you and tell you that median lines are the end-all and be-all. They're not. They're a leading indicator. That's what I like about them. They're also easy to use. That's another thing I like about them. They have a mathematical probability. It's another thing I like about them. Good friend of mine is Joe DiNapoli. He likes to use fib analysis. I would tell you, look, there's lots of tools out there. Most important thing is, can you master yourself? Can you have self-discipline? Second of all, if you have great money management and use good risk-reward, better than 3-to-1, you're going to be a long ways ahead of the rest of the market. So I'm not going to stand here and tell you that median lines is the only way to go, or action-reaction lines. Market structure is extremely important. All those other things, put them all together. Should median lines work on daily or weekly? Yeah, of course they do. Does this only work 50? No, it works with any time frame. One of the favorites that we use on Breakfast with the Masters is we like to trade natural gas, and we like to trade soy meal with 189 tick charts, which is really fast. Some of the bars are 30 seconds. Some of them are 6 minutes, but that takes time out of the equation. So it'll work with anything. What leverage is okay? My favorite's 1.6 of your account. How much you're charting is straight use? Did that one already? Let's see. I'm sorry, I didn't get your answer on the best time frame to use for median line for intraday. There is no best time. Arturo, how are you? There's no best time, best time frame. It depends on you. For example, if I said to you 20 minutes is the best, well, what if that's too fast for you? What if you can't what if you can't draw that fast and think that fast and do your calculations and fill out your trade plan that fast? Then you shouldn't be on a 20-minute. You should be maybe on a 60-minute or a 120 or on a 240. What if you like to hold trades overnight? Well, then you shouldn't be on a 5-minute chart. You should be on maybe a 240 or a daily. So it depends on you and what you're trying to do. But intraday, and if I was doing currencies, I'd probably start with 20 minutes and then decide if it was too fast or slow, and you can always adjust. Practice first. Explain what I mean by market structure, okay? Swing highs, swing lows, double tops, double bottoms, ranges. Those are all market structure. How do I decide between the yen or the Aussie or going into gold or grains on any daily, day, or weekly basis? Is there something that triggers your interest in that particular equity option or foreign exchange? Well, here's the first thing. One thing I can tell all you, there are a trillion markets. I can't even tell you how many markets the CME now has, but they have a lot of them. They have, I know Pete's probably not listening anymore, but I want to say, did he say 69 or 169 currencies? That's currencies alone. Then you have currency options. Then you've got, I mean, you know, it goes on and on and on and on and on. So you have to limit the net that you're throwing out there. What I suggest to most people is they shouldn't be looking at more than 3 to 5 things. Then, if you're looking at 3 to 5 things, once you see something that interests you, you should stop looking at the other 2 to 4 things and just concentrate on that and stalk that and see if it turns into a trade. If it doesn't, then go back to the more general approach of 3 to 5 things. But after that, I don't think you have enough focus to do more than that. Can I anticipate direction when price approaches energy points? Nope. What you know at an energy point is that price is going to make a decision. Okay? It may reverse, it may accelerate, or it may congest. But when it gets to those energy points, generally the physics or mathematical description is it becomes more and more unstable as it gets closer and closer to those energy points. So don't just say, okay, it's getting to the energy point, let me just assume it's going to reverse. That's going to be a loser for you. Jeffrey, would you do me a favor? You asked me about PPT. Tell me what you're, I'm not sure what you're asking. Can you rephrase it, please? Hi, Ace, how you doing? Are you still using 233 tick charts in trading? Do you still prefer tick charts over range charts? I do not. I'm not a range chart guy. To me, it hides too much market structure. I use all kinds of different ticks. It depends on the market. For example, in gold, my favorite is 888. When it comes to soy meal, I like 189 or 89, depending on how active a day it is. Natural gas, 89, 189, or 377. So it really depends on the market. Hang on one second. I'm getting caught up here. You get mastery of yourself by live trading. No, you know what, TJ? You get mastery of yourself by being disciplined. For example, if you're eating and you can't discipline yourself, you're going to get fatter and fatter and fatter, or you're going to get sick because you're eating the wrong things. It's the same thing with trading. You know, if you take 2 positions that are too large over and over and over, you're going to blow your account up. If you don't follow your rules, you'll have no way to go back and take a look and see whether what you were doing was successful. So you're going to have to discipline yourself. You're going to have to figure out exactly what you want to do, write it down, then do it over a period of time. And then at the end of each month, you're going to have to go back and say, okay, how did this work out? And then evaluate each of the trades, see if you can find, if you followed your plan, find out which parts of the plan are working and which parts of the plan are not, and then make changes. Your answer to leverage is 1.6 of account at risk, but I mean leverage on Forex of what to 1. Well, if I had, let me say it again, Bob, if I had $100,000, the biggest loss I'd take would be 1.6% of that. So it's difficult for me to get to where you're trying to go, Bob, because when I trade for myself and for my clients, I actually don't use any leverage, 0. So if I'm trading a CME contract that's $100,000, I trade 1 contract for $100,000 of capital, okay? And then I set my stops based on, you know, equivalent risk. So I know you want a black and white answer. It's not that simple. Steve says, how do you decide on 3 to 5 things to focus on? Are you looking at the volume on the price swings? No. I'm looking at pretty pictures. Quite literally. Price swings is close to that, but I'm not looking at, I want enough volatility, not too much. I don't really care about volume. Volume means nothing to me unless it's a liquid, specific market or industry. Well, I mean, I might be wanting to trade currencies this week. Maybe currencies are active. There was a period last year where Aussie, you could do no wrong. It was so easy to trade Aussie. Well, it just meant that when I got a bet, I was most likely going to start with an Aussie chart. If it didn't work, that's fine. Let's see. Okay. You're asking me about industry standards. So you want to know, in Switzerland, they're talking about 3% leverage ratio. This is for institutions. Here in the U.S., the Feds have talked about 5 or 6% of money of valued assets. Does that have anything to do with me? No, it doesn't. It has absolutely nothing to do with me. First of all, I've been trading long enough that I have something called a Reg 47, which means that none of those things apply to me. Second of all, excuse me, I actually trade for countries, so I don't fall under any of those things. Rob says, I'll actually say this publicly, Rob. You're not going to embarrass me. Have you mastered your weight yet? Rob, actually, I've lost over 100 pounds since that picture that you see. I'm going to have to have Cynthia update that picture. And I actually work out at CrossFit. I don't know if you've ever heard of CrossFit. They are rehabbing me. I have, at one point when I moved to Arizona, I was in a wheelchair and using oxygen. I now work out at CrossFit 3 days a week, 2 hours at a shot. And it helps my breathing. I'm getting pretty mobile these days. I'm able to lift quite a lot. I'm not trying to be a weightlifter. I'm trying to improve my lifestyle. So yeah, my weight's just fine. Let's see. Do I believe in market profile? Actually, Peter, you might find this interesting. I put up the initial investment for market profile. Market profile's fine. The problem when we did it initially was computers. There weren't enough computers around, and so for real-time use, which is what I was interested in at the time. Once we had it done, Pete Stottlemyre pitched it to me, the idea, and I could see the chart immediately, and I thought, well, this is a great way to represent what's going on in the market. The problem was computers weren't fast enough, and there weren't enough people updating prices on a live basis, so that once we got it built, it wasn't useful at the time. And, I was more than willing, as you know, it's now owned by the Chicago Board of Trade. I was more than willing to take all claims away and say, yeah, that works for me. Let's see. So, yeah, and I have several people in mentoring that use market profile, and I show them how to use median line on market profile. I have no problem with market profile. I've been using median lines for years, and in my experience, every new user of this incredible strong tool should be warned that median line use in the beginning could bring to overconfidence. Sure. Hi, Giuseppe, how are you? And this could be the biggest mistake. How you doing, Giuseppe? That's absolutely true. What happens is you actually see price turn on a dime so many times on your lines that after a while you get complacent about it, and you may not put stops in, or you may put stops in and they're too large. You may start picking tops and bottoms, and that's just not a good idea. With all things, you have to continue to use discipline, and even though, as Giuseppe said, a lot of times you'll just see you can't believe how accurate it is. You always have to have protection. You always have to discipline yourself. Always do the same thing over and over. Make it repeatable. Tomas, how are you? I'm very sorry I didn't catch that. Please, can you tell me again what ATR to use for stock? 200 and 55 are different. No, I use a 200 period and a 55 period, and you could use a 34 period for your lower one. You want a longer one and a shorter one. And the reason why is the shorter one will pick up very quick changes in volatility. The longer one will tell you the long-term trend. And then you always want to base your decision on whichever the number is the largest of the two. Okay? Let's see. Yep, I already did that. For an eager novice, should I apply this methodology to a lower volatility stock in order to learn the trend? Well, the word trend is overused, okay? What this tool is going to do is it's going to show you the probable path of price. If you want to call it a trend, that's okay. Lower volatility, just use it daily or weekly when you first start to draw until you become familiar, whether you're using currencies or whatever, and you'll find that there's a lack of pivots. Then you'll have to move down to 480 minutes, 240 minutes, 120 minutes, 60 minutes. The key, though, is to draw and draw and draw and draw, okay? Do I ever have to report your volume? I'm pretty much exempt. As a matter of fact, I don't know how you feel about that, but for those of you that for example, rely on commitment of traders and live intraday volume, for example, looking at DOME at, the 5 bids and offers, there's a lot of people that can trade outside of that. So, don't get so hung up on volume. For example, let's say you're looking at the bids and offers. You go, oh, my God, there's 12,000 on that bid. Big deal. A lot of them aren't real. So you get mastery of yourself by measured performance of your technique under fire in order to develop your confidence. That's a good description, TJ, yeah. And I would do the same thing if I were you. I'm even using sim trading. It's always better when you have money on it. Use a small amount of money. So you're slim and trim. Yep. I don't know about speed and agility, but I'm getting better. Yeah. Is taking a trade with 3-to-1 the same as another one with 9-to-3? Yeah. Sure. It's the ratio. Right. Absolutely. Let's see. Oh, somebody already answered. Okay. What software programs do you use? Well, I have every software program, including IB's all packages. Everybody gives me everything. I chart a lot on Ensign because a lot of people in market geometry use Ensign. You can get a package, and Cynthia will show you this page. IB offers has a page that shows you the different packages. You can get different charting packages with IB. You can use IB's charting package. You can use IB's feed and different charting packages. I mean, I just haven't used Ensign because that's what most of the people at market geometry use. But I can use anything I want. eSignal used to be Advanced Get, which was built by somebody that actually studied under Andrews. So, I mean, I know all about that. Somebody asked about the Horn of Plenty by Dr. Andrews. The Horn of Plenty and the Fisher and Nets is another one. Those are my 2 favorites. And when I was a teenager and I was at Dr. Andrews' house, I lived down in South Florida with my brother in the summers. I asked him one day about the 2 of them, and I said, "You don't really use those to trade, do you?" He used to call me the pansy when I was a teenager because I wouldn't stop and reverse trade like he did. But I only had a $2,000 account, and I said, looking at, for example, the Fisher's and Net, you could make a trade every 2 ticks because they're 10% angle. Same thing with the Horn of Plenty. The Horn of Plenty has to do with expanding pivots. I wouldn't bother to spend time studying either one. There are more important things to study. Can I take the 5th grade challenge? You can't take the 5th grade course. Only 5th graders can. But next year, it's sponsored by Michael Dell, another friend of mine. It was quietly being paid for by Steve Jobs when he passed away. We were looking for a new benefactor. Michael Dell has picked up the ball. Next year, Dell Corporation is going to sponsor the whole shebang. We're going to do 5th graders and 9th and 10th graders. So that'll be interesting. Let's see. Oh, for a day trader, you previously said use a 13-minute bar for E-mini S&Ps. Yes, but Bart, there's a caveat to that. If I'm going to use a 13-minute, then I use day only, not 24-hour charts, and I start my day at 8:30 Chicago time and end it at 3 o'clock, not 3:15. And the reason why is E-mini S&Ps in the day are open for 405 minutes. Okay, that's an uneven time. Cash is only open for 390 minutes. So what I do is I mimic the cash stock market, by charting from 8:30 in the morning to 3 o'clock, which is when cash ends. That's 390 minutes. Then I use either a 39-minute or a 13-minute, which are both divisible into 390 minutes, and trade that. And I don't look at the overnights. I might look at the overnight high and low, but that's all, okay? Appreciate all the nice words, Hans. Let's see. No. Thank you. Hi, Tomas, and thank you as well. Let's see. Do I trade foreign exchange? Bob, I'm one of the largest forex traders in the world. Literally. Tens of billions of dollars at a shot. So yeah, and I've been trading foreign exchange since it was legal in the United States. At the time, in 1978, when the CME, we opened a new division. I've had a CME seat since 1980. The CME at that point had different seats, and we had to open a new division to trade what became foreign exchange futures. Individuals couldn't trade cash foreign exchange. That was called the IMM, the International Monetary Market, and that was done because a gentleman by the name of Milton Friedman, who was my mentor in economics at the University of Chicago, I was part of the study group that helped him put together the treatise that talked the CME group into putting together currency futures. How many monitors do I use? In my trading, in my old trading room in Chicago, I used to have 12. Sitting in front of me right now, here's what I have. I have two 37-inch monitors, which are on. To the left of me, I have two 37-inch monitors, which are asleep right now. And the reason why they're there is because I have servers that mimic each other, that are rated, which is a technical term, means that they always back up each other. If one goes down, the other one's live. I have duplicates of everything. Behind me, I have two 34-inch monitors, and the reason they're there is because if I use a webcam when I'm talking to somebody, they can see my face, and then behind me, they can see me drawing. But how many monitors do I actually use? Two. Less has become a lot more to me now. I trade currency, cash foreign exchange, and futures both. I love futures because they're transparent, and you know, you don't have to worry about the spread, and you know exactly where the price is, et cetera, et cetera. There's a lot less games played. And how do I know about the games? Because I used to be a market maker in cash foreign exchange. So, Jay, don't worry about missing the majority of this seminar because, as you know, you can go back and get the recording. Don't worry about it. I'm not too familiar with average true range. How do I use this with futures? Is there a calculation? It's on every charting package there is, Jay. Don't worry about it. But what it is you look, it's the actual real range. So if prices gap 10 ticks lower, it's not the high and low of the day. It's the high and the low plus that 10 ticks. Then we do an average of those true ranges. Are they used for stops only? Really, that's all I use it for is for stops. What I want to do is I want to use some value of the ATR plus some noise above it to set up my size of stops. How much cheaper will the yen get? I don't forecast, sorry. I can tell you this, Pete. I've traded at 178 and I've traded down to 78. So, you know, it goes all over. And again, I'm not going to forecast timing. Is it comparable to trade currency futures instead of forex? It's the same. Rosa, the only difference is when you trade currency futures, it's a set amount, depending on whether you're trading the micro or the regular contract. And second of all, it's for a set date. You're trading in March, June, September, or December. You don't have to do any rolls. If you're trading in cash foreign exchange, you're trading 2 days out, or depending on who you're trading through, they might have a date that you can trade out to. Otherwise, you have to roll, pay the roll, or earn the roll each day. Hey, Carlos, how are you? Carlos is one of my guys here. When you day trade, how many days back would you draw a fork, or do you keep the fork in the same day? You know, Carlos, I'm always looking at 3 days-ish when I'm intraday trading, unless it's at 240. But if I'm looking at like 20 minutes, I'm looking at 3, maybe 4 days at the most, and the fork pretty much is well within there. I just move on. And that's you again. Let's see. I'm refreshing the list. I appreciate that, Pete. I might take that as as a good thing. What percentage of ATR for stops? It's not a percentage. Generally, something like ATR plus noise. So, for example, when we were looking at the yen, the ATR was 20 when we started out, and what I said was that was the larger of the two was 20 ticks. I said I'm going to add a minimum of 5 ticks to the largest ATR to get to my stop. Do I ever get stressed when trading? Everybody gets stressed, but I'm a lot less stressed than I used to be. First of all, because I've slowed down. Second of all, my life's a lot more balanced. And I've got a 13-year-old and a 15-year-old. How do you think trading is compared to dealing with them? Sure, everybody gets stressed. But you know what? If you get stressed, if you have a position, close your position, walk out, go see what a wonderful day it is, take the day off, and realize that hey, this is not the end-all and be-all. Otherwise, you're not going to make it. Is your fork Andrew's pitchfork? Yes, that's right. I studied under Dr. Andrews for 17 years. Can you show in a webinar when you trade short-term with tick charts, the soybeans? I don't do soybeans very much intraday. I do mostly dailies, but I'll do soy meal for you if you want. We love to trade soy meal. Hi, Cynthia. Is it Vasili or Vasil? Do you hedge your positions when you portfolio trade? Nope, I do not. I'm in or out. So if I don't like the position anymore, I'm out. And in terms of correlation, I don't think about my positions in terms of correlation. And even things, for example, some of you may not know this, I trade for the Queen of England. At one point they asked, what currency should we denominate the trading accounts in? Who cares? We're going to be trading them anyway. It doesn't matter. So I don't worry about those things. It's meaningless to me. I'm at the end of questions, Cynthia, unless you got some hiding somewhere.
Wow.
I don't think I've ever run out before.
Well, I think they're usually coming throughout the event as well, but thank you everyone for putting up with us and trying to get the bulk of the presentation done before we start getting off topic a little bit here and there with all of those questions. But this actually will bring us, well, first of all, there were some questions that did come in, and I do want to quickly, and what I'm going to do, Tim, I think I'm going to grab the ball back from you for just a moment, because I do want to go in and show a couple of the websites and where
you have to do that, please, because that's my favorite part. I know maybe it sounds like I'm, playing to you, but I really think this is important. If I was learning how to trade, or if I was a retail trader, and if I didn't know this was here and somebody showed it, I'd go, man, are you kidding me? I didn't know this existed. This is so cool. Go ahead. I'm all eyes or ears.
Well, first of all here, what I do want to do is show you, and going back to Pete's comments early on in today's session, notice if you happen to go to Interactive Brokers website, interactivebrokers.com/CME, it actually will redirect you to this page that we produced jointly with the CME group. It gives you a market snapshot. You'll find upcoming webinars are included over on the right-hand side. I'm glad they've worked with me on that. And then also notice there's a quote board with some market news and analysis.
Hey, Cynthia.
Yes.
Wait, scroll back up. I see my buddy Dan.
Yes.
Dan and I are good. I mean, we're hugging, kissing buddies, okay? How do I get my picture on this page?
We'll have to, let's take that offline and discuss it with the CME group. Yeah, now, this actually
I'm just giving you and Dan some razz, that's all. Because every time, he looks so good in his suit, doesn't he?
Oh, he does, and he takes pictures well, too.
Yes, he does.
We'll definitely have to let him know.
Sorry.
But actually,
go ahead, because I really love this website. Go ahead, keep going.
Dan actually does daily market commentary on 21 of the different CME group markets. So it's a quick 5-minute read if you want to get an overall review. But
and Dan gives good. I used to say, I've done a lot of seminars and panels with Dan. He just gives what we call it. We gives good presentation. Gives good portfolio presentation. He's a nice guy. I've known Dan since 1980. So.
Well, also, what I want to do is show them where they can access not only today's,
cool.
First of all, we do record each of these events, and by registering, whether you actually can attend live or not, you'll automatically get that direct link to the recorded playback. But I do want to take you again out to our website. Underneath the Education menu, you'll find the Webinars section here. Now, upcoming webinars are always listed here with the direct link to join that session, but also notice you can sign up for any of our upcoming webinars with these live events, but I want to take you out to the recorded sessions, because here is where you will find a wealth of knowledge, whether it's on Trader Workstation tools that are available, our APIs, or let's actually go into the industry-sponsored events, because here is where you'll be able to see or find Tim's previous recordings. Now, we do have quite a bit on this page, so notice what we've done is added a filter at the top, and I'm going to simply scroll down on this filter and find Tim Moore's listed here. Notice as soon as I do that, you have just activated this page with all of Tim's previous recordings. So if you'd like to come out and revisit any of these, wow, Tim, this is amazing. Oh, it looks like our 2007 event actually did drop off the page.
We got to find it. You know what, if I pop a couple of the prior ones to you, well, they'll have to go through compliance. If they go through compliance, put them back up, because I've got them back to 2005.
Okay, excellent. I think there is a time limit with our WebEx platform where they do drop off.
Okay. All right.
So looks like it only goes back 5 years. But these are available, everyone, by the way, for download as well. So if there's some of these earlier events that you don't want to miss out on, simply click this link and download it. Then you have it there and available. By the way,
if you can't find it here and it's rolled off, if you go to Market Geometry, we have a tab for interactive brokers. It's there.
Excellent. You have my back. Thank you so much, Tim.
I'm not, you know, we got to cover each other, darling.
Well, I also want to point out, notice here the notes link. The notes is actually Tim's slides from each of these presentations. So if you do want to get a copy of the slides, it is available here. By the way, I also want to just point at this icon that's included. Not only is it nice color added to the page, but notice that you can also download the player as well. So if you do download these events, you'll actually need the player for the playback. So just make sure that you download that once, and then any of these events will pop up and play back for you.
Let me give you one real quickie here before you move.
Okay.
Every once in a while I get these emails, and somebody will say, well, I click, and they say it like really nasty. I clicked on the link and I have to register. And let me just tell you, don't worry about it. You're not going to get one email from Interactive Brokers. They're never going to spam you. I have, you know, I'm signed up under 18 different emails. My wife's signed up. My children are signed up, because I need to know whether or not things are going out, whatever, right? You'll never get spammed by Interactive Brokers. So don't be worried about it. You do have to register. It's not a big deal, but what the registration does is it tells you, hey, here's how to get in. Here's how to get the notes. So don't worry about it. You know, I mean, you know, lighten up, guys.
Yeah, well, thank you for that, Tim, too. And that's also a way that we can actually quantify the interest in these events. And by registering, you'll see that we've now been able to bring Tim back on a monthly basis. Thank you very much, Tim. And that's what your registrations actually do help us to do. Plus, it allows us to send out that recorded playback. So if you do register, that's the only piece of information that you'll get back from us. So please do, and don't be afraid. Now, also, Tim mentioned a couple of other items here, because there are with several other packages that are available. Now, Interactive Brokers does have a platform, but if you want some of the more advanced topics, notice underneath the products menu, there is a marketplace at IB. Here is where you can find other products or other charting applications specifically that may have some of the more advanced concepts that you're looking for. Notice here we can go in, as I scroll down on this page, there's software tools. We even have programming consultants for anyone looking for an API, but there's also educators as well. And we have Tim listed in the education menu here too. Let's see, here we have it right up at the top of the page. So you can find out some additional information and even rate the information that you do get. But let's move back a page here because it is, whoops, let me go back to our marketplace. That is where you can find some additional features. I'm going to scroll down here, especially for let's go back to the software tools, charts and data. So if you're looking for a more powerful charting package or some additional features that IB may not provide, simply scroll through here and you'll be able to locate information, especially, by the way, you could even search under Ensign. So if you're looking for that same charting package, you can hook up the IB feed to the charting software. So with that, that's all the sales routine that you're going to get from here. So I'm going to move.
That's pretty light. I mean, if you think about it, that's pretty light.
Well, I'm going to take us back over into our event today, and I do want to thank everyone for participating. Also, I do want to put a plug in for the CME group because what we've done coming up this year is actually structure a School of Futures. So if you're looking to learn more about trading futures products, Pete Molmat, who is with us here, delivered our intro here today, we'll be delivering the very first in a 12-part series on the School of Futures. So please check that out. It'll come up 2 weeks away from today. Now, also want to remind you that Tim is going to be back on a monthly basis. You can look for his information every second Thursday of the month. We're trying to keep a very strict schedule here so that folks can come back and join us. Now remember, if you don't join us live, you can always access any of those recorded playbacks from our website. We don't have the topic listed yet, but I'll be pestering Tim later on or early next week for a topic description. Yeah, here we go.
The pressure's starting already.
And so do take a look. If you don't see the information posted, we always do have it up by the end of the month. And just remember that you can always access any of these events. If you put a reminder in your calendar on the second Thursday, go to the webinar section where you can see a direct link to that to the session. By the way, I do get questions on our passwords, and the password for all of these events is the same. It is IB Trading. So if you get the password one time, you can join us whenever, whether you register, pre-register, or simply choose to join us day of the event. So with that, what we are going to do is end today's session. I want to thank Tim Morge, especially for all of the work that you put into these events. We all so appreciate your time, Tim. Thank you so much. And I also want to thank the CME group because it's their dedication to training traders that really makes these events possible. So with that, we are going to conclude our event today. And by the way, as you exit the session using the X in the upper right-hand corner, be on the lookout for a pop-up window or a pop-up new browser window which will open up with the PDF copy of today's slides. You can print them from there or simply download and save. So thanks everyone for the time you've spent. We really do appreciate it. And have a great day, everyone. And please remember, trade smart all. Thank you. Thanks everyone. Have a good day.
Thanks, Cynthia. You take care. Everybody, Happy New Year. See you next month.
That's right. Good start to the year. Thank you, Tim.
All right, bye-bye.